Imagine this. You run a household that looks totally fine on paper. Your main credit card bill? Pretty manageable. Your income? Still solid. Your savings? Not terrible. But then someone opens the closet. Behind the neat official bill is a pile of IOUs you've been sliding under the door for years. Loans your spouse took out to renovate the kitchen. A temporary tab with the contractor that never got paid. A line of credit your cousin co-signed because you promised the house would go up in value forever. Now zoom that household up to a country of 1.4 billion people. Because that's basically China right now. The world has spent the last decade staring at US federal debt, and for good reason. But here's what most people don't realize. The scarier debt story in 2025 might not be Washington's. It might be sitting in Chinese provinces, cities, and counties, where the borrowing isn't just big. It's hidden, tangled, and running out of oxygen. First, quick disclaimer. China's official fiscal numbers are cleaner than most countries, but local level data is not. Even international institutions that do work with Beijing warn that the real perimeter of Chinese government debt is much wider once you include off-budget local vehicles. So everything you hear in this video is based on best estimates from groups like the IMF, ratings agencies, and longtime China analysts. Not because they're perfect, but because they're the only people even trying to count the whole iceberg. If you pull up a simple chart of government debt to GDP, China doesn't look like a crisis country. The IMF's narrow number, basically the clean, on-budget stuff, puts general government debt around 60% of GDP in 2024. That's below the US and way below Japan. So why all the panic? Because that narrow number is like judging a company's finances by only reading page 1 of the annual report. The IMF runs a second measure called augmented debt, and they explicitly say it includes local government financing vehicles, or LGFVs. Using that broader lens, China's augmented debt hits about 124% of GDP in 2024 and is projected to keep rising. And even that is conservative, because it's still trying to estimate a shadow system built to be hard to see. So what are LGFVs, and why do they exist? Here's the origin story in one sentence. Beijing wanted growth. Local governments wanted money. So they invented a workaround. Back in the 1990s and 2000s, China was basically doing the most aggressive economic catch-up in human history. The central government set GDP targets like commanders setting battle plans. Provinces and cities were judged by how fast they could build, expand, and industrialize. Local governments didn't have enough revenue. After China's 1994 tax reforms, Beijing took a bigger share of tax income, while localities kept most spending responsibilities. Schools, hospitals, subways, roads, industrial parks, social housing, you name it. So, locals found a loophole. They created companies owned by the city or province, LGFVs, and these companies borrowed money to build everything the local government wanted, without the debt showing up directly on the government balance sheet. Think of it like this. If a city can't legally max out its own credit card, it gets its friend to do it, and quietly promises to pay later. For years, this looked genius. LGFVs borrowed. They built highways, transit lines, new districts, industrial zones, and entire cities. Land values rose. Property developers paid huge fees for long-term land leases. Local governments used those land sale revenues to pay interest on the loans. It was a circular engine. Borrow, build, land gets richer, sell land, repay, borrow again, bigger, and as long as the property machine kept rising, the loop felt stable. Then 2021 happened. China's real estate boom cracked. Developers like Evergrande couldn't roll their debts. Homebuyers stopped trusting pre-sales. Prices wobbled. Construction slowed. And the most important domino for local finances fell. Land sales collapsed. Land sales and property-linked taxes were the oxygen tank for local budgets. When that tank shrank, the whole LGFV model started suffocating. Local governments didn't just lose a revenue stream, they lost the revenue stream that was underwriting the debt treadmill. Analysts note that LGFVs were designed to rely on land sale cash flows, and that support dried up with the property downturn. So how big is the hole? This is where the numbers go from big to wait. What? One major IMF-linked assessment cited by Atlantic Council researchers put LGFV debt at about 58 trillion yuan on the books. Beijing's own response pushed a different figure, suggesting overall LGFV debt around 44 trillion yuan. Still monumental. Either way, we're talking about a shadow debt pile in the tens of trillions of yuan. And LGFVs are only part of the hidden debt story. Localities also owe contractors, suppliers, and private firms piles of overdue payments. By the end of 2024, estimates of arrears alone were near 10 trillion yuan. That's not an accounting typo. That's a second fiscal system living in the walls. What does a debt crisis look like if it's local? It doesn't start with fireworks. It starts with weird headlines. Contractors not getting paid, public workers seeing wages delayed, local hospitals and schools cutting back, cities shelving infrastructure projects midstream. The Wall Street Journal reported localities holding back wages and pensions under debt strain as land revenue plunged, describing mounting public frustration. That's the real danger of local debt. It directly hits day-to-day services. National debt can be abstract. Local debt is your bus route, your clinic, your teacher's paycheck. But here's the puzzle. If this debt is so frightening, why haven't we seen a classic emerging market blow-up? Why no mass defaults? Why aren't bond yields exploding? Because China doesn't run a normal debt market. Most local debt is held by state-owned banks and domestic investors who can't freely move money abroad. Capital controls keep savings inside the system. And for decades, everyone assumed Beijing would never let a local government fail. That assumption created an implicit guarantee, which means borrowing stayed cheap even when the balance sheets got ugly. But assumptions are fragile things, and once they start cracking, markets can reprice very quickly. Beijing knows that. So in late 2024, they rolled out a rescue, a massive one. China announced a multi-year debt swap and refinancing package worth around 10 to 12 trillion yuan, roughly 1.4 to 1.7 trillion. The basic idea? Local governments and LGFVs get to swap high-interest, short-term hidden debt for lower-interest, longer maturity official bonds. In other words, Beijing is trying to turn back-alley IOUs into a structured mortgage. Fitch estimates this debt substitution can lower interest costs, but relief is uneven and doesn't erase the principle. So is that the solution? Maybe. But also, maybe not. Because debt swaps don't make debt disappear. They relabel it. It's like refinancing your credit card into a 30-year loan. Your monthly payment drops, but you still owe the money for a very, very long time. Analysts have described Beijing's strategy as extend and pretend, postponing the moment the central government fully absorbs the bill. And postponement has side effects. Moral hazard. If local officials believe Beijing will always bail them out, what's the incentive to stop borrowing? That's why the center is also cracking down, delisting LGFVs, pushing some into commercial status, and forcing them to stand on their own. But here's the catch. Many LGFVs were never real businesses. They were financial scaffolding for government projects. Remove the guarantee, and you risk defaults. Keep the guarantee, and you risk more reckless borrowing. Pick your poison. Economic drag. Local governments were China's growth engine. They built first, asked questions later. Now they're switching into survival mode. When a province is busy rolling over debt and trimming budgets, it's not launching new innovation hubs. It's not funding big infrastructure waves. It's not confidently hiring. The IMF is blunt that local government debt and the property slump are major downside risks to China's medium-term growth. Stress in the banking system. LGFVs borrowed mostly from banks. Local banks are often heavily exposed to local borrowers. And when local borrowers wobble, local banks wobble. Beijing can stabilize the system. It has the tools, but every rescue pushes risk upward into the central state. That's why in 2025, the Ministry of Finance even created a new debt management department explicitly focused on central and local debt and hidden debt risk. That's not something you do when you think the problem is solved. Meanwhile, the macro backdrop is getting worse. China is fighting something most economies hate: deflation. Falling or stagnant prices make debt heavier because your nominal income doesn't rise while your nominal obligations do. So even if Beijing rolls debt into cheap bonds, weak prices and weak growth make the burden stickier. So where does this go from here? There are basically three paths. The slow merge. Beijing keeps swapping, refinancing, and quietly absorbing local liabilities into the central balance sheet. The center issues ultra-long bonds, uses policy banks to refinance, and stretches the repayment horizon across decades. This is the Japan-style slow burn scenario. Ugly, but controlled. The local squeeze. Beijing refuses to fully centralize the bill, and localities stay locked in austerity. Growth slows further, public services thin out, and private firms suffer from arrears and weak demand. You don't get a crash, you get a long stagnation. Confidence snaps. If property gets another shock, if a major LGFV default cascades, or if households lose faith that local governments can pay, then the implicit guarantee breaks. When that happens, yields spike, refinancing costs jump, and Beijing has to choose between a panic bailout or letting parts parts of the system fail. This is the tail risk. Not guaranteed, but not impossible. And here's the deeper takeaway. China's local debt crisis isn't just too much borrowing. It's a structural consequence of how China grew. For 30 years, the model was investment over consumption, construction over services, local growth targets over local balance sheets, property as the financial engine. That model built highways, cities, and manufacturing dominance. It also built a debt pyramid that only works if land prices rise forever. But land prices don't rise forever. Not in Tokyo, not in Miami, not in Shanghai. So when you hear someone say, China's government debt is only 60% of GDP, it's fine. Remember, that's the visible iceberg tip. The real mass sits underneath. In LGFVs, land finance, arrears, and rolled over loans. Beijing is trying to freeze the iceberg in place before it drifts into the shipping lane. Whether that works depends on two things. China can't fully command anymore: confidence and growth. And that brings us to the question that should keep policymakers up at night. Can China rebalance its economy away from property and debt-funded investment fast enough to stop local finances from bleeding out? Because if the answer is no, then this isn't just a local government problem.